We're going to look at a few important relationships involving present value. First is pretty commonsensical. The expected cash flow is important. So you want to know the present value, and all else equal, the higher the expected cash flow, the higher the present value. So again, that should make sense that the more you expect in the future, all else equal, the greater the present value is going to be. And we have an example here that's going to illustrate that. Suppose you're expecting $100,000 in 7 years from now, and the discount rate 7%. That has a present value, 100,000 divided by discount rate of 7% per year for 7 years, equivalent to getting 62,275. Well, what if you're going to get $200,000 in 7 years at 7%? Well, as you can see, the present value for that is higher than it is for 100,000. Specifically, it's twice as much. So again, this one's pretty commonsensical. Length of time. Again, this is another one that is a little bit less commonsensical, but one that you guys all, that my students generally identify, and that's that longer time leads to lower present value, all else equal. So this is the piggy bank example, where we had 3 piggy banks. They all had $100,000 in it. They all had no risk, so they had the same level of risk, and students almost always, if not always, recognize that the longer I have to wait to get my $100, the less valuable that piggy bank is. The sooner I get my piggy bank, the more valuable that piggy bank is. So basically, the longer, all else equal, as t increases, then present value decreases. So again, remember, if we have to wait 7 years to get our 100,000, 7%, it's worth 62,275. What if we have to wait 14 years? Well, we would say it's worth less, and now we can say exactly how much less it is. It's 38,782. 100,000 discounted by 7% per year for 14 years is 38,782. And remember that the present value times 1 plus r to the t is equal to ct, because it's the amount of money that if we invested it for t years at a rate of r would give us that cash flow. So here we have 14 years to get to 100,000, so we would need to start out with less money. Or the flip side, which is the one that people can gravitate to, I think, quite easily, is that if I get my 100,000 in 7 years, it's going to be more valuable than if I get it in 14 years. So discount rate. We've talked about discount rate. Where it comes from, it's related to the risk associated with cash flows. So therefore, if we have a particular asset, the riskier that asset is, the riskier those cash flows are, the higher the discount rate. Again, remember, investors don't like risk. Companies don't like risk. People don't like risk. So in order to accept risk, in order to take on risk, the reward is expected to be higher. So there's going to be a trade-off, and therefore the greater the level of risk, the greater the discount rate. Another way of thinking about it is the greater the if I have to wait and I expect to get $100,000, if that's really, really, really risky, then I'm going to discount it by more. I'm going to penalize it by more. If something's really, really safe and I have to wait 5 years for it, I'll penalize it by less. And so again, the relationship is that all else equal, the higher the discount rate, the lower the present value. So again, remember, you're dividing by 1 plus r to the t, so the greater r is, the greater the denominator is, the greater the bottom of the fraction is, and the lower the entire fraction becomes. And again, you can see it in the equation here that as r goes up, present value goes down, but also as the discount rate goes up, as we discount our cash flows by more, a greater rate, they're going to be worth less. And why are discount rates high? They're higher because they're risky. And so the greater the risk, the more I'm going to penalize something, the less it's going to be worth to me. So again, our $100,000 in 7 years at 7% is worth $62,275. What if you expected $100,000 in 7 years, but it was riskier? There was more risk associated with it, such that the discount rate was 14%. Well, then it's 100,000, and you're discounting for 7 years, but now you're discounting by 14%. It's only worth $39,964. It's worth less. Alternatively, imagine I offer you two alternatives. They both are expected to pay you $100,000 in 7 years, but one is safer and one is riskier. Which one would you rather have? You would rather have, and most people would, the safer one. They're both expected to pay you $100,000 at the same point in time. The only difference is risk. We don't like risk, so let's take the safer one. And here we can see numerically that the fact that we would prefer the safer one is reflected in a higher value. So in well-functioning markets, and specifically when we make the assumption that we've made of the flat yield curve, all investments, all assets with the same amount of risk have the same discount rate. Otherwise, we would have a disequilibrium. In order to have an equilibrium, we need to have all assets, all investments with the same risk have the same discount rate. And so we're going to assume in this class that financial securities investments are well functioning. And this allows us to value assets, value investments in a comparable basis, in which case the relationships, all else equal, the riskier they are, the less valuable they are. And again, it's important, it's all else equal, as we showed in this example where all else was equal. It was 100,000 in 7 years. One last point. The discount rate for a project or for an asset, and basically the appropriate discount rate that we often use, is often called the cost of capital or the opportunity cost of capital. And here's why. Firms have at least two choices for using cash. One is to invest in a project, buy an asset, and that has a certain expected cash flows and some particular level of risk. The other thing that or one of the other choices, and this is the one in particular that we're interested in, is they could take that money and instead of putting it into this asset or this project that had a certain level of risk, they could invest in financial securities, stocks and bonds with the same risk as the project. And remember, the markets for financial securities, they're well functioning, so for that level of risk, there's a certain expected return associated with it. So they have two alternatives that both have the same level of risk. This one has an expected return that's determined on the financial markets for all stocks, all bonds with that level of risk. They all have the same expected return. And therefore, we call it the cost of capital because the decision to pursue this project means that we give up the chance to earn this expected return. So by doing this with this level of risk, we miss out on the opportunity to earn this expected return for the same level of risk. And the way we incorporate the fact that we're giving this up, the fact that there's a cost associated with pursuing a project or investing in an asset, is by having this expected return be the discount rate. It's called the cost of capital or the opportunity cost of capital. But again, the discount rate is related to the risk. And in particular, if we're trying to find the present value of a factory or a piece of equipment, and we need to discount the cash flows that we expect in the future, we would say, how risky is that piece of equipment? How risky is that factory? Let's find stocks and bonds that have the same level of risk. What's their expected return? And that is what we would use. That rate is what we would use as our discount rate, our cost of capital for the asset, the equipment, the building that we were looking to value.